Hi, I'm Ross Mayfield, investment strategist at Baird, and we are back for another weekly update with our partners at Strategas. Today, we are lucky enough to be joined by Chairman and Chief Investment Strategist Jason Trennert to talk all things markets. Jason, how are you doing today?
I'm doing great, Ross. Good to be here.
Yeah, good to talk to you. A lot to get to, and I want to start with a somewhat simplistic question, if you'll forgive it, but there's a lot going on in the world, both geopolitically, domestic politics, over at the central bank. And yet we sit here at a market, at all-time highs and looking somewhat broad as well. What do you make of the state of play as we head towards the end of the year here?
Well, listen, I think generally speaking, markets, as one of my partners, Dan Clifton, has talked about, markets tend to do very well during election years because incumbents or proxies for incumbents in this case generally tend to grease the skids to get the economy going. Obviously, the Fed's easing. The Fed's probably going to continue to ease. It may not be as much as people are expecting, but you have accommodative monetary policy. And then in terms of some of the geopolitical risks, which are real and worrisome, U.S. In some ways tends to benefit from that, obviously, because it's viewed as appropriately as a safe haven market. So I think if you put all those things together, it's a pretty bullish setup. We found largely that the market has gotten into trouble in the last 2 years when 10-year Treasury yields are above 450, but below 450 as they are now. Generally speaking, the tide is higher.
Yeah, and it generally seems like a pretty risk-on environment. As you mentioned, the Fed lowering interest rates has typically been good for those more economically sensitive and rate sensitive types of stocks. Yet I've seen you write recently, a bit about high quality stocks and a preference for high quality and maybe even dividend payers or dividend growers. I'm curious if you can kind of explain your thinking in a preference maybe over a full cycle for that higher quality type of investment.
Yeah, I think, Ross, the hard part here is that since the advent of QE in 2008, there really hasn't been much of a business cycle. I mean, even the recession that was a result of COVID, according to the National Bureau of Economic Research, they think it lasted only about 2 months. So it makes it harder from a traditional point of view to manage money because you just have this very elongated expansion. And I think there's a risk to doing that by not allowing markets to clear, and that risk eventually will be higher inflation and higher long-term interest rates. That suggests that you want to be in companies that are somewhat less levered, or companies that generate their own cash flows to grow, as opposed to what we've been calling longer duration assets. And so that's kind of where we are. It's hard to see, the long duration stuff really does really well generally when you're kind of towards the end of a contraction. That's when kind of a rising tide lifts all boats. And right now, I would say we're pretty late into an expansion, although, it could be, again, kicked into extra innings.
Yeah, and you all have done some work on what the typical length of a bull market looks like and how, versus history, we're pretty early on or short into one at this point. But that moving into year three, returns can be a bit more tepid. I don't think anyone would be surprised if returns more closely tracked earnings growth, with valuations where they are today. How are you thinking about entering year three? And then maybe a thought or two about the earnings backdrop as we head into the new year as well.
Yeah, so Ross, I tend to agree with you. I think there is some, I would say, incongruity between, and they're different investors, I guess, but the bond market's looking for 6 rate cuts over the next 14 months or so. At the same time, the equity market investors are looking for a 15% increase in corporate profits. And I would say those things don't generally go with one another. If the Fed is cutting 6 times, you either have a productivity boom or the economy is really weakening. Or on the other hand, if you have the 15% profits growth, it would suggest to me that you're going to have fewer rate cuts than people are expecting, which probably would make it more difficult to get any sort of multiple expansion. So we have a much more single digit type approach or outlook for the market next year. Although I will say with the proviso that single-digit returns, although often forecasted, are rarely come to pass. Most of the time it's either feast or famine, and it's more on the feast part than the famine part. But it's hard to make a big bull case, it seems to me, for big double-digit types of returns in the equity market, kind of given where we're starting.
Jason, this has been incredibly insightful. I want to thank you so much for the time, and hopefully we'll get to talk to you again soon.
Great. Thanks for having me, Ross. Anytime.